the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors and the companies to watch. But as always, a quick recap of some key movements. While Singapore shares fell today to track losses in Asia, so the Straits Times Index was down 0.59% at 4,216 points at 2:44 p.m. Singapore time, and that is with a value turnover of 1.11 billion Sing dollars seen in the broader market. Now let's take you through the closing numbers. Losses easing there on the STI. So the STI closed down 0.28% at 4,229 points. In terms of value turnover, we're looking at 1.68 billion Sing dollars. Gainers trailed losers 205 versus 371. Top advances for today, we've got for UJMX USD, Holpa and HBL. And top decliners, we have here SIA, UOB and UOB Kay Hian. While in terms of counters to watch, we have Singapore Airlines because SIA reported a 58.8% drop in Q1 FY2026 net profit to 186 million Sing dollars yesterday. Now that's even though revenue rose 1.5% to 4.8 billion Sing dollars. Now elsewhere, from how China's government spending hit its highest level in nearly 2 decades to how the greenback is strengthening against the Sing dollar, we've got more international headlines in focus. And joining me on the line is Jeff Ng, Head of Asia Macro Strategy at Sumitomo Mitsui Banking Corporation. Jeff, welcome back to the show.
Hi, good evening. It's great to be back.
Great to have you. And Jeff, let's start with global markets this time around. Stocks fell today. The positivity sparked by the recent U.S. trade deals announced seems to have dissipated. So even though Trump's agreement with the EU reached over the weekend that was seen as better than a tariff standoff, observers pointed out that the 15% levies on EU goods were still much higher than before. So taking that into consideration, how did Asian markets fare today? Are investors taking that wait-and-see approach as they await any outcome, or the outcome, rather, of US-China trade talks?
Yeah, I think for today, it looks more negative than not. The previous sort of like optimism that there's more certainty around all these trade deals dissipated. And I think markets are looking at the kind of winners and losers that is coming out from these trade deals. So it looks like I think the US may have gotten quite favorable terms at the expense of other economies, other blocs such as the Eurozone. Previously, I think the US also appeared to have achieved some positive deals compared to those for Japan, for Vietnam, Indonesia as well. I think ahead of more announcements coming from US-China trade talks, I think markets are potentially focusing on the economic impact because of the fact that the US is having broad tariff on most, if not all, major trade partners. It's likely to take a hit from the increased cost of doing business, and for the other countries as well. So it's also bad in the sense that all the unfavorable terms may also weigh on the sentiment. So it looks like a lose-lose all way around, which may weigh on the sentiment.
Yeah, and if we could go back to the Singapore stock market as usual, Jeff, it seems like the STI is back in the red after being in the green for many days. How did the STI fare today, in your opinion, then? And any surprises when we look at the biggest movers and the sectors that they lie in?
Yeah, when I last look at it, I think it's about down by minus 0.4%. It looks quite broad-based with, I think, decliners outpacing the advances by 2:1, thereabouts. It looks like all the interest rate related sort of like stocks, financial sector stocks, as well as the activity-related stocks are not doing too well. I think perhaps of the fact that interest rates are lower compared to before. And then there's some, I think, headwinds for the activity-related stocks, which may weigh on the earnings and also perhaps weigh on the outlook going forward. So it means that there's some sort of like cautiousness and pessimism seeping into the outlook for the Singapore market. amid some concerns from the global headwinds that we have seen so far.
And Jeff, if we could zoom in on the counters to watch, we have Singapore Airlines, because SIA reported this 58.8% drop in Q1 FY2026 net profit to 186 million Sing dollars yesterday. And that's even though revenue was up 1.5% to 4.8 billion Sing dollars. I know you do not comment on individual firms, and I also know that there's a part of that results that's attributable to, Air India as well. But generally speaking, what is the outlook for Asia-focused carriers given the current travel momentum and also ongoing tariff wars on perhaps cargo as well?
Sure. I think for the carrier-related industry, I think there's always idiosyncratic company-related factors that macro analysts do not cover. But I think generally, when we look into two components for this area, one is on passenger travel. I think this is still expected to be fairly positive because services sectors are not so much affected by the tariffs. And I think that demand for travel and movements still continue to be fairly high post-pandemic, even though I think growth rates may depend on, the ongoing economic growth, the consumer sentiment going forward. I think what could be weighing down for this sector is on the freight and traffic around this region, owing to the fact that previously there has been a lot of front loading that had gone on. And I'm expecting some slowdown to come in, especially in the last quarter of the year, when a lot of this front loading has already occurred. I think companies may have prefer to choose to wind down their inventories rather than to import more. So this may mean that the activity levels for freight movements, no matter whether it's between regions or between countries or maybe even within the country, that may slow down due to the higher tariff level. So the outlook now may be not too positive, but maybe by next year, if the economic outlook improves, the momentum can then recover.
I see. Now, if we're just tuning in, we're now in conversation with Jeff Ng, Head of Asia Macro Strategy at Sumitomo Mitsui Banking Corporation. And Jeff, if we could stay in Singapore, the US dollar has climbed nearly 1.5% in the past 6 days, reversing that downward momentum we saw for much of this year. And in tandem, most Asian currencies have retreated, Singapore dollar being no exception there. The greenback also strengthening against the SGD this month. And if we look at the USD-SGD currency pair, it has climbed 0.8% from 1 Singapore dollar and 27 cents on 23rd of July to around 1 Singapore dollars and 28 cents yesterday. So what are the levels to watch for the currency pair? What will a likely move by the MAS be in managing the dollar near?
For the dollar Sing, I think resistance level in the near term could be close to 1.3, owing to the fact that the dollar has rebounded. I think the fact that the US is getting some favorable terms from the trade deals, some dissent from some European leaders saying that the deals are not too favorable, alongside the fact that I think the US economy is still relatively strong. We saw that the PMI numbers this month showed that the economy is still broadly in expansion, even as the manufacturing sector face some headwinds. It means that the dollar may see some near-term rebounds after weakening previously. While we still expect some dollar weakness over the next 12 to 18 months, that could come from close to 1.3 level, closer towards 1.25 perhaps in 12 months' time. And MAS will announce their monetary policy tomorrow. We're expecting them to stay on hold, keep in a wait-and-watch mode. If the economic situation deteriorates, I think they will possibly move towards no appreciation of the Sing in the coming meeting, maybe in October. But the demand for Sing dollar will still be fairly high, amid some demand for safe haven, so that could anchor at move closer to 1.25 in a year's time.
Now, across the region, Jeff, let's set our sights on China. China's government spending has pivoted towards social welfare to a degree unseen for at least a generation. So, while Beijing is channeling less on budget investment into infrastructure, expenditures that covers outlays ranging from education to employment and social security, that climbed to nearly 5.7 trillion yuan, around 1 trillion Sing dollars for the first half, the highest for the period since the data series began in 2007. How would you read into the news? What does it mean for the Chinese economy, and how will it filter through to Chinese equity markets then?
Yeah, I think it means that the stimulus from the authorities are quite targeted, and I think they have pinpointed the areas that is still fairly soft for them, which is the bit of the domestic economy and also on the social welfare as well, to sort of like help to target those that could be affected by the current economic slowdown in China. I think it also means for the China economy that we may still see China growth close to 5%, if not perhaps even surpassing the target of 5%. After first half, I think we saw growth above 5% in the first half of the year. So with some of these measures, I think this will help to alleviate the headwinds as the front-loading sort of like momentum tapers off, and it will help to moderate the economic growth throughout the next few quarters. For the outlook for Chinese equity markets, I think they can also draw some strength from this, perhaps because a part of it could also be related to consumer spending. And China, over the medium term, they are shifting away from an export-led model towards consumer consumption-centric model. So that will be supportive on the fringes, but the longer-term implications will still depend on whether the momentum can be sustained. So yeah, I think overall it still hints at some stabilization ahead.
Okay. And finally, before we let you go, Jeff, Apple is closing a retail store in China for the first time, marking a notable retreat. So how far will slowing consumption, though, in China weigh on big American names in both the retail and tech industries, particularly those with exposure to China? And how far can we see the impact of that and the earnings reports due in the coming days?
Yeah, we see a lot of sort of like product competition, not just in China but also globally. And I think the consumption outlook in China is still fairly sort of like benign and conservative at this stage, owing to the subdued domestic outlook. So it may continue to weigh on sort of like not just the American companies, but also global companies who are seeking to see some sort of like increase in market share or increase volumes in China. I think overall the heightened competition and also the uncertainty around the tariff may still weigh on the domestic outlook in China, which may mean that while the overall growth momentum in China still stays at around 5%, some sectors like the domestic consumption sector will still be a bit more subdued. So it may mean that companies that are exposed to this China consumption story will still see some headwinds for the next 6 to 12 months.
I see lots to watch indeed. Thanks so much for the insights today, Jeff. That was Jeff Ng, Head of Asia Macro Strategy at SMBC. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.